Obviously, and we just heard President Bonga speak to this, the notion that so much still remains unclear as to the trajectory of the war in the Middle East and therefore the impact that it ultimately could have on growth or inflation. My question to you is, even if it were to end here, how long the economic ripple effects could last, even if we do get to some kind of peace in the near term?
Great to be with you. The answer is longer than most people think. This is anything but a light switch. You can't turn it on or off in a heartbeat because of the damage to the infrastructure that's been done, as you've heard, and because of some unique dynamics in energy markets. We often talk about these prices as having a rockets and feathers kind of dynamic or a elevator upstairs down situation where prices rise a lot more quickly than they go down. We at the CEPR group that you just mentioned, where I'm a policy fellow, we estimated what we think the gas price is going to do, the retail gas price for the rest of this year. It does not come back down, at least in our forecast, and I think that's quite consistent with others that I've seen, to the pre-war level for the rest of this year. So we see continued pressures, probably not as bad as we saw in April, if the scenario you just outlined holds, but certainly worse if it doesn't.
Well, and to this notion of gasoline prices staying higher for longer, or perhaps diesel prices is better for my line of questioning here, Jared. Obviously, we talk about headline inflation up 0.9% in the data we just got. When you X out food and energy, understandably, the number is a lot lower. But should we expect that due to things like higher diesel prices, which affects how things are able to transit through this economy, that the energy inflation we're seeing is going to feed through into more wider underlying inflation?
I think that's precisely correct. Look, pass through takes some time. It doesn't happen in a week or a month. And therefore, my expectation, and again, this is, I think, common among forecasters, is that we'll see more energy pass through, and by energy, I'm including things like fertilizer, in food and in airfares as we go. And airfares, by the way, do feed into the core. So there should be some pressure there forthcoming. I was glad to see the grocery price essentially flat in April. I'm sorry, in March. I'm sorry, no, it was the April report, the March report that we got in April. I was glad to see the grocery price flat. But my expectation is that will be higher in some forthcoming prints. The other thing we have to be concerned about is the impact on real wages. This is something a number of us have been elevating today, because here we have a longer term trend of slower nominal wage growth colliding with higher inflation. Again, just as the interview you played from a minute ago suggests, a lot of the inflation part is a matter of duration. But if you believe my story about pass through and rockets and feathers, I think there'll be continued pressure on real wages going forward.
Well, and so that is also likely feeding into consumer sentiment, right? The idea that you perceive prices going higher and your wallet is not necessarily getting fatter in order to afford those higher prices, Jared. So when I look at the UMich consumer sentiment numbers dropping to a record low in this morning's data, 47.6, at the same time that inflation expectations jumped a full percentage point, 4.8% over the next year. We know, and we hear this consistently from the Federal Reserve, that inflation expectations and managing those is their real concern. How quickly do you think that this could potentially spiral?
So this is a very interesting question and an important data series, the University of Michigan sentiment. And I actually have a few comments responding to what you just said that are a little more upbeat than you might expect, and then I'll
we could use a little positivity on a Friday, Jared.
Yeah. I'm going to give you a sort of one, which is the following. If you look at 1 year expectations in the UMich survey, this is people, this isn't price setters, this is regular folks telling you how they feel about the economy. So it's not, when I say price setters, businesses or owners of retail gas stations. You will see that it follows the gas price. You get a spike in the gas price, you get a spike in the UMich 1 year expectations. Look at the 5 year expectations and you see it went up just 0.2. So I don't think, if I were the Fed, I wouldn't be weighting University of Michigan 1 year expectations particularly high. I wouldn't get that too heavy a weight. I'd look at it, I'd note it, and I would worry. I would definitely worry about inflation expectations getting dislodged, and we've heard Chair Powell express that concern. The broader point, and here I'll go back to some pessimism that I think is just really unfortunately warranted, is that there has been this is not a one-time thing in this UMich report. There has been such a pronounced downtrend in how people are feeling about the economy, almost regardless of some positive macroeconomic statistics, whether it's GDP or productivity or a relatively low unemployment rate. People feel really bad about the economy they experience on a day-to-day basis. A lot of that has to do with affordability and prices. And boy, this war really exacerbates that challenge for them.
Yeah. Well, and of course, largely that is because of the still effective closure of the Strait of Hormuz. Jared, we just got a True Social post from President Trump alluding to that. He says the Iranians don't seem to realize they have no cards other than a short-term extortion of the world by using international waterways. Arguably, that actually is a pretty large card that the Iranians have to play, and we've seen that borne out with the Strait of Hormuz. But it speaks to the notion of a potential supply shock, energy side supply shock for the global economy. You joined the Council of Economic Advisors in 2021 in the Biden administration in the aftermath and in the midst of, frankly, a supply shock that started from COVID. Then there was the supply shock that emanated just years later from Russia's invasion of Ukraine. If we have this kind of supply shock that we're now dealing with, how would you be advising this White House to navigate it? What policy response is there if we can't get to a ceasefire or an agreement?
Well, first of all, let me just say that that card that Trump is being dismissive, in fact, you might even call it a Trump card, that the Iranians have, this regime in the Strait of Hormuz, is a very, very powerful card to play. And he's very much wrong to dismiss that. Now, this whole thing hinges, a lot of what we've been talking about, the economics of the war, hinges on what happens with transit through the strait. And thus far, what we've seen hasn't been particularly promising. And what's particularly discouraging is that this misadventure in the Middle East, in the Persian Gulf, has really signaled to the Iranian regime, which is as hardline as the one as it's been in decades, that they have this card to play. We've empowered them. So look, the best thing you can do is tell Americans the truth and do the best you can to maintain this ceasefire and try to back out of this situation you put us in.